For millions of Malaysians, saving for the Hajj is a lifelong devotion. But the institution trusted to protect these hard-earned deposits, Lembaga Tabung Haji, was operating on a legal framework riddled with structural blind spots. The primary law governing the fund is the Tabung Haji Act 1995. This legislation granted extensive, almost unchecked powers to overseeing ministers. Because Tabung Haji was viewed primarily as a religious institution, the public granted it absolute trust. That faith inadvertently masked a system operating without the strict financial guardrails required for a modern investment fund. Section 6.2 of the Act stipulated the requirements for board members. To sit on the board of this multi-billion ringgit fund, an individual only needed to be a Muslim and a Malaysian citizen. There was no statutory requirement for actual financial or economic expertise. Compounding this was Section 6.5, which gave the Minister of Religious Affairs the absolute authority to terminate any board member at any time, without providing a reason. These two legal provisions created a highly vulnerable boardroom. Between 2014 and 2018, active politicians were appointed to senior positions, stripping the fund of its independence and aligning its decisions with political objectives. This lack of independent oversight allowed management to make sweeping, unstudied changes. In 2016, they quietly altered the underlying deposit contract from a profit-sharing model to a safekeeping arrangement known as Wadia Yad Tamana. Previously, Tabung Haji paid business zakat for depositors. Reclassifying funds as safekeeping made Tabung Haji a borrower, shifting higher savings zakat liabilities to depositors. Bank Negara Malaysia flagged this severe statutory conflict directly to the Prime Minister in 2019. Broad ministerial power and vague statutory language took a protected national savings trust and turned it into an opaque vehicle for political maneuvering. Tabung Haji's original mandate was singular: safely hold and grow Hajj savings. But leadership expanded this vision, attempting to build a high-risk corporate conglomerate branded as the pillar of the Ummah's economy. To execute this expansion, Tabung Haji executives and board members placed themselves on the boards of dozens of subsidiary companies. The overlap was staggering. One former chief executive officer held 18 concurrent directorships, while a chief financial officer acted as a proxy on 23 different boards simultaneously. This dense web of overlapping roles obliterated objective oversight. When those proposing massive investments sit on the approving board, the conflict is structural. The accountability loop broke completely, as executives monitored losses on the very ventures they authorized. The leadership became so consumed with corporate expansion and managing subsidiaries that they lost sight of their primary responsibility, protecting the pilgrims' deposits. Stepping outside their core competency into complex, large-scale corporate investments led to severe financial hemorrhaging. In 2012, Tabung Haji heavily subscribed to the initial public offering of FGV Berhad. They held on to the shares as the price steadily collapsed, ultimately suffering an unrealized loss of 1.05 billion ringgit. In Indonesia, a joint venture called True Rich aimed to develop oil palm plantations. It failed to generate returns, leaving the subsidiary insolvent and burdened with over 119 million ringgit in net current liabilities. In Saudi Arabia, an investment in the Anfal real estate fund collapsed when the fund managers simply vanished amid labor issues and rising material costs. The investment was completely written off, erasing 76 million rials. Yet, while the parent fund absorbed these massive losses, internal boardrooms at the subsidiary level continued to authorize hefty, unearned special bonuses for their directors. Entities like TH Properties and THP Australia approved these payouts to executives, completely insulated from the financial damage they were inflicting on the larger institution. Rewarding executives for catastrophic financial performance drained the institution's capital from the inside. Why would a conservative religious savings fund feel compelled to take such aggressive, reckless gambles overseas? The answer lies in crushing internal pressure. Through its financial assistance program, Tabung Haji was subsidizing up to 57% of the actual cost for pilgrims to perform the Hajj. At the same time, political pressure demanded artificially high dividends, or hibah, to satisfy depositors. This dual mandate reduced distributable profits by 400 million ringgit a year. The required cash outpaced the fund's actual conservative returns, making the financial math impossible to sustain. The very policy designed to help pilgrims perform their religious duty became the exact mechanism that forced the fund into a desperate cycle of high-risk investing to cover the shortfall. By 2017, the intense financial pressure caused the system to buckle, and management began manipulating internal accounting rules, inconsistently changing financial asset impairment policies twice in a single year, a move heavily flagged by the Auditor General. To hide the depth of the crisis, leadership authorized dividend payouts before the annual audits were even finished, rapidly draining the institution's final protective reserves. The fund required a massive government intervention. A special purpose vehicle, Urusharta Jamaah, had to be created to absorb billions in toxic, underperforming assets just to keep Tabung Haji solvent. When the Royal Commission of Inquiry investigated the crisis, their core recommendation was clear: the power to regulate the fund must be separated from political control. Noble intentions and religious devotion are not enough to protect a national trust. Only strict statutory independence and genuine financial expertise can safeguard the savings of the people.